All right, in part 2, we're going to talk a little bit more about some theory aspects and ultimately how we can utilize this risk analysis that we've been talking about. So let's talk about a theory. It's called the capital asset pricing theory, and it is a theory that connects the risk and return with respect to all assets. So it helps us kind of get in line with the way things should work with respect to given levels of risk. We'll talk how we measure that, and ultimately the returns that you should expect from certain kinds of investments. So let's start walking our way through a little bit more of an analysis or an understanding of what risk is. Total risk is that entire combination. Obviously, it's the standalone risk of an asset, and it is measured by standard deviation. Now, total risk has two parts. It has a diversifiable part and it has a non-diversifiable part. Diversifiable risk can be eliminated just by adding more stocks together or by adding more assets to the portfolio. And if we do it strategically and add things that have low correlations, the diversification happens much faster. Non-diversifiable risk is stuff that we are stuck with. You can't eliminate it through diversification. Frequently, this is actually referred to as systematic risk or market risk. Now, if investors are rational and they're creating portfolios, when they create portfolios, they get diversification. So in the end, the only relevant risk in the decision-making process is non-diversifiable risk. Again, why is that true? Number one, people use portfolios. People can eliminate this just by purchasing and spreading their risk out over more investments. So this is the way that we can obviously eliminate things. And if you can eliminate it and it really doesn't cost you more, everybody would want to eliminate as much risk as they could. So then you would be left with this market risk. Oops, sorry. So our formula basically says total risk is market risk plus company-specific risk, or the non-diversifiable plus the diversifiable. So what kinds of things create market risk? Interest rates and inflation. Inflation, I think, is the easiest thing to think about. Inflation's bad for everybody. So if it's bad for everybody, then by adding securities together, you won't be able to offset the bad impact of inflation because everything's going to be hurt. However, company-specific risk only affects certain companies. So if you have a portfolio with 20 to 40 assets in it, what's the chance that every single one will go on strike or have a lawsuit? Very little chance of that. So some may, some won't. So that's the parts, those things statistically get averaged away. So if you look at the formula for risk, for variance, this is the variance of a portfolio. This is a two-asset portfolio. The risk that you undertake, asset A brings some risk, and if you remember, the W's are weights. Asset B brings some risk. Again, the variance here is the risk element. And then there's an impact from the interaction of assets. Again, if you take the square root of all these, each one of these should be a positive number in this formula. The only one that could be different from a positive number is correlation. That's this, rho AB, the correlation between assets A and B. If that was 1.0 or as big as it could be, there would be no elimination of risk at all. On the other hand, if it was 0, this whole piece would become 0, and obviously the risk now is less. Finally, if it was -1, it would be this line item, since it's a product, would be as negative, if you will, as it could possibly be. In fact, we might be able to eliminate some of the risk that each asset brings to the party. So again, this is a formula that helps us kind of understand a little bit about how diversification happens inside a portfolio. Now, what happens when we add another asset? We get another set of these for each asset, of course, but now we also get a set of these for every pair. So as we continue to add asset upon asset, there are these excuse me, relationships that continue to add up. And since since the W's, since we're adding more assets, will get smaller, each piece is going to get a smaller and smaller interaction. But when you add them all together, we're still going to be able to eliminate and diversify some of the risk away. There is a graph that represents how, when you add securities in a portfolio, the total risk, that's this top line, the total risk of the portfolio decreases. So if this is total risk, from the blue line down, the piece that's disappearing, this upper segment, that's the diversifiable piece. The non-diversifiable piece is that piece that no matter how hard you try, you can't get below that level. So that level gets very small, right? It gets, or the total risk gets very small to the non-diversifiable risk in total when you get out around 30, 40 securities. So if you have roughly 40 securities, you should have a portfolio that essentially is only market risk. There should be very little, if any, diversifiable risk in that portfolio. So if we have portfolios that have very little diversifiable risk, we need to have a way to measure market risk. And the way we measure market risk is through something called the beta coefficient. It's a relative measure of market or non-diversifiable risk. It tells me how the asset responds to changes in the stock market. So the beta correlation for the entire stock market is 1.0. So all other betas are measured relative to the stock market. And again, the stock market return is obviously that rate of return that you would expect if you would buy the stock market itself. So there is a market return that has a market risk value, a beta of 1.0. So let's see how we might do this. Here's two portfolios, if you will, or two assets, I'm sorry. This is the relationship between Hewlett-Packard and the S&P 500. The dots here represent the returns at specific periods of time. And again, you can see that they're all spread out, that they're not really bunched all that closely together. But if we could create a line, and statistically we can do that with regression, we can create a line that describes this portfolio. And you can see that it is obviously positively sloped. It's not terribly steep, but it is a positively sloped line, which means that beta is positive. Now here's Disney, right? And Disney, we can create the exact same line between Disney and the S&P 500. And I hope essentially what I'm trying to show you here is that this line is a little steeper, that we would expect the beta for Disney to be a little bit higher than the beta for Hewlett-Packard. So we can, if we know the returns of stocks and we know the returns of stock markets for periods of time, we can calculate their betas. So how do we interpret this? Again, 1.0 basically is the same stock, the same response as the stock market. So anything greater than 1 would be more risky, and anything less than 1 would be less risky. Now we also, though, have positive and negative. So if the sign is negative, right? It has the same response as the stock market, but it has the opposite. So if the stock market would go up by 5, this would go down by 5. It is the exact identical relationship, but opposite in sign to the stock market. So if you have a beta of 0.7, you have a beta that is less risky, or an asset that is less risky than the stock market. Here are some examples. We'll talk about some of these in class, but obviously you can see here are some betas that are representative of some very big companies that are, most of them I would imagine are in the S&P 500. And you can see some are rather large. Xerox is 1.86, Ford is 1.56, and we have some that are fairly low. We have Walmart at 0.42. This energy company is 0.38. So we have low betas, we have high betas. Oh, again, what I really wanted to do, I put the second one because this is from 2010 and this is from 2013. And they use the same company. And what I wanted you to see from this graph is that although beta measures risk, it's not stable. It doesn't stay the same forever. So here, if you look at Walmart's 0.29, if we go up here, Walmart is 0.42 now. So what we would say is, compared to the stock market, Walmart has become more risky since 2010. And we can do the same comparisons with those other companies. So now that we know what the betas are, how do we use that? The first thing we can calculate is we can calculate the beta of the portfolio. And the beta of the portfolio is just the weighted average of the betas of the individual assets within the portfolio. So here we have two portfolios, and here's our investment. I have 10% in asset 1, 30% in 2, 20, 20 and 20 in 3, 4, and 5. So I have all of my money invested, 1.0, and here are the betas of portfolio V. I have the exact another portfolio. We have different assets, and they have different proportions. So what we want to do is calculate the betas of each of these portfolios. So you can go to the portfolio beta and return worksheet, and you can input the weights, input the betas, and in this case V has a beta of 1.195 and W has a beta of 0.91. So what can we say about these portfolios? The only thing we can really say about them right now is that V is riskier than the stock market on average. W is less risky than the stock market on average. And quite frankly, you can also add to that that obviously V is riskier than W. So how does the capital asset pricing model fit into this game? How does it express itself to explain risk and return? So the risk-free rate we've talked about in a previous chapter, you can get that from a treasury bill. I mean, they say a 3-month treasury bill. Since we're talking about stocks, it probably makes sense to have something closer to maybe a 20 or a 30-year treasury bond, but they're fairly close together. The risk premium is the difference that we get from the stock's return to the risk-free rate of return. It's the risk that's additionally added. Well, part of that risk comes from the stock market. R sub M, that's the return on the stock market, minus the risk-free rate is what we refer to as the market risk premium. So we know there's the risk-free rate, and then there's also a risk for investing in the stock market. So when we look at the formula, this is referred to as the security market line formula. The risk-free rate is first, and then to that we want to add the riskiness of the company. Well, R sub M minus R sub S. This is the risk you get, or the return you get, if you just invest in the average stock in the stock market. And this beta is the specific risk of this individual asset. So you take the individual asset's risk times the risk premium, the market risk premium, and this tells us what required rate of return you would expect to get if you would buy this stock. So the risk premium, again, how do we calculate this? We said the stock market in general is averaged around 9.3. One of the other tables was actually even up a little higher, about 11.7. Treasury bonds, we had about 3.9%. But essentially, to find the historical risk premium, you take the stock average return and subtract out the treasury bond, or the risk-free rate. So in this case, we end up with about a 5.4% historical risk premium if you invest in stocks rather than investing in the risk-free asset. So what can we do with this? Well, you can take the risk-free asset and plug it into the risk-free rate. Okay, this obviously comes from that same the graph we were just the portfolio beta and return worksheet. Here's the beta that we calculated or we determined, and then the market risk premium is at 5.4%. So if you take 5.4%, this stock you would expect to get around 10.4%. For the other portfolio W, it had a beta of 0.91. You would only expect to get 8.8% for that stock. Now, if you didn't know the market risk premium, you just as easily could have plugged in here the average rate of return for the stock market. So maybe there we might have plugged in our 11.7% from that previous table. Again, the goal here is to estimate or forecast what you think the expected return should be based on a given level of market risk. So here we have this Benjamin company. The beta is 1.5. They're saying that the risk-free rate is 7 and that the return on the market portfolio is 11. So here's where I plug that in. And again, this particular stock should have a return of around 13%. So what happens if the stock market changes its returns? Well, if you have a stock with a beta of 1.5 and the stock market increases by 15, what would you expect to happen to this stock? If the stock market goes up by 15, you would expect this to go up by 22. Why more than the stock market? Because it's riskier than the stock market. With the other one, it has a beta of 0.25. So if the stock market goes up by 15, it'll go up only by 3.75. Why less? Because it's less risky than the stock market on average. Again, we talked about this formula. It's called the security market line. It gives us a graphical representation of the relationship between the returns of stocks and the betas of stocks. So this security market line, risk-free is at 7. The stock market has a beta of 1, so the stock market has a return of 11. And this is where we find. So asset Z, right, has a return of 13%, right? What does that come from? Here's the risk-free rate, and this additional piece comes from the assets risk premium. So how much of that came from the stock market? Here's the stock market's additional piece, and from 11 to 13%, that's the additional risk you get for just investing in this particular asset Z. So what happens to the security market line over time? We've already talked about the economy changing and that beta is not necessarily stable. So what happens if inflation changes? If inflation were to go up by 2%, the risk-free rate would go up 2%. So what that would do would create an increase in the security market line, but across the board, everything would go up in expected returns. Another thing that happens in the economy from time to time, investors get skittish about the stock market. They get a little scared. So when people's expectations change, when the way people look at the stock market changes and their risk aversion changes, that's going to cause a tilt or a swing of the security market line. So in this case, the risk-free rate stays at 7, but because everybody in the market is now a little bit more risk averse, the security market line shifts upward. So the CAPM actually relies on some historical data, so we know that there's some changes, so it won't always give us a straightforward, very predictable, exact number, right? So we know that they're only approximations. The capital asset pricing model assumes that stock markets are efficient. We talked a little bit about that, and I think we've kind of come to the conclusion that the stock market is fairly efficient, but it's not perfectly efficient. So in a perfect world, again, it may seem like the capital asset pricing model will give us very true, very predictable returns, but we don't live in that world. So in general, we have a capital asset pricing model that's going to give us an idea of where the return should be on a particular stock. That's the end of Chapter 8.